Good evening, everyone, and welcome to Forex Street webinar. Today is 5th of May 2015. My name is Nenad, and today we will talk about how to determine correct lot size for an entry. There has been a lot of discussion in Forex trading, and people usually do not know to distinguish Forex trading from gambling, from over trading, and basically most of the people are losing, not because of the system, not because of the method, but it's because of incorrect lot size and psychology. So we will deal with that today, and if you are to basically ensure that you can respect these rules, you are one step closer to becoming a profitable trader. So before we begin, as always, our risk disclaimer: online educational materials are developed by Admiral Markets in Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Risk disclosure statement stating all possible risks associated with the Forex market. By accepting the risk, you're also proceeding further with me. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not AMUK's opinions, and the website in the video is not a .co.uk website, but the globalnews.com website. Forex is risky business, and this is a personal opinion only, and this webinar is for informational and educational purposes only. So with having said that, we are ready to proceed. Today's agenda: money management, scalping, intraday trading, long-term trading. Unfortunately, money management script will not be included with this file. For that, you need to email me, and I can send you, of course, money management script as always. So you probably know that we talked a lot of times about this, and my primary rule is that money management is maybe of all things which are important, the most important one. So successful trading is based on so-called tripod of successful trading. So in order to trade successfully, we need to have a profitable trading strategy, which is a systematic approach based on technical analysis and fundamental analysis. We need to develop good skills for risk management or money management, and we need to have a stable trading psychology. These are all important things in trading, and that tripod is successful as long as all three legs stand. If one falls, all will fall. So we don't want to have any of these legs crumble, okay? So profitable trading strategy, proper risk management, and within ourselves, proper trading psychology. You need to set 3 tasks before you start to trade. Primary task is not to lose a capital and stay on the flow for many years. As I always say, Forex is a marathon, and you're a long distance runner, so you want to stay on the flow for many years. You need to gradually multiply your equity figures, not just by gambling. And third, earn profits. I know that a lot of people, and really, in my trading career, I have encountered many times that people come to me and say, okay, this guy has made 30% in a single month, that guy has made 200% in a year. So what I think is, we all can gamble, right? So Forex can, and Forex allows us to gamble. So we can always risk 10% per trade. We can always trade by our margin. We can always try to go in front of the market, but usually that kind of trading strategy and that kind of trading approach will not be profitable over a long run. Problem with many people is that they set a third task for the first place. And many traders set the first task to be to earn profits. Okay? But our primary goal is not to lose a capital and stay on the flow for many years. That way we can also earn profits. But if we set the third task, which is to earn profits for the primary task, the chances are that we will gradually, not multiply, that we will gradually lose our equity. I think personally that, as I previously said, all three things are important. Having a good system, of course, psychology, but I think most of the time, maybe a little bit more important thing in Forex trading is to have a proper risk and money management. Because you don't want to be profitable just in a single month or in 3 months' time. You want to try to be profitable at least 6 months in a row. Okay? At least. Risk management. We need to say that, as I said, that is maybe the most important part. Speculating is not gambling. Okay? Speculating as a trader is not gambling. The difference between gambling and speculating is risk management. Okay? In other words, with speculating, you have some kind of control over your risk. Whereas with gambling, you don't. So that is not correct. Many people will tell you that Forex trading is gambling. Now I'm telling you, Forex trading can be gambling, but it's not gambling. The difference is your approach to Forex trading. And the difference is risk management. Even a card game such as poker can be played with either the mindset of a gambler or with the mindset of a speculator. Risk management is keeping your risk under control. The more controlled your risk is, the more flexible you can be when you need to be. And Forex trading is about opportunity. You need to be able to act when those opportunities arise. By limiting your risk, you ensure that you will be able to continue to trade when things do not go as planned, and you will always be ready. Using proper risk management can be the difference between you as a professional trader and you as a losing trader. Okay? Fundamental and technical analysis aspects are also very, very important. With technical analysis, we always say that basically that is the first thing you do when you get up early to trade. To do that, you need to grasp technical analysis aspects. You need to understand the dynamics of the market which you are trading, and you need to know where the psychological price trigger points are, risk factors, where price chart can help you decide. If you make a decision to trade and to take a trade, then the next most important factor is how you control or manage the risk. If you can manage your risk or measure your risk, better to say, if you can measure the risk, for the most part, you can also manage it. Okay? Remember what I'm saying now. If you can measure the risk, for the most part, you can also manage it. In stacking the odds in your favor, knowing both fundamental and technical analysis aspects will help you. It's very important to accept the risk up front before you trade. And that risk should be Accept it before you even take a trade. Okay? You need to draw a line in the sand, which will be your cut-out point if the market trades to your stop loss. So you need to know your risk. That is a very, very important part in trading. You need to determine risk per trade. Do not forget, trading and taking a proper lot size in a single entry is not about how much you will earn or how much you are willing to earn. It's about how much you're able to lose. So before you even take a trade, you should determine risk. And risk is something which should be fixed. If we make our business plan and if we make ourselves to take only 0.3 or 0.5 risk per trade, should be our principle, main principle where we can govern ourselves when trading, okay? But if you want to make a bigger risk, then guys, you need to be also able to accept bigger losses, because it's the rule of the thumb in a forex market, guys. Remember now what I'm saying, and do not let others to fool you. If you want to make 100% per year, you need that is very, very, very truthful, and that is the big truth in forex market. You need to accept that you will lose your account. If you want to make 20%, you need to accept at least 20% of a drawdown, unless you are trading with robots and you can be basically cut out from trading by your broker if they catch you to trade arbitrage, or you trade high frequency trading, which is definitely forbidden. Any good broker will cut you out from trading if those kind of trading approach is observed. Arbitrage trading, high frequency trading is not allowed. Okay? Normal trading, a normal part of trading involves accepting the risk and the biggest drawdown compared to your profit ratio. So if you want to make 30%, then be ready for a 30% of a drawdown. Be ready. I'm not saying that you will make 30% of a drawdown, but be ready. But if you want to make 100%, then guys, you need to be ready to lose a whole account. That is not what I suggest, and that is not how I do it, how I trade. Let alone how I teach people to trade. Risk factor to study also is liquidity. But let's say what liquidity is. Liquidity means that there are a sufficient number of buyers and sellers at current prices to easily and efficiently take your trade. In the case of the forex markets, liquidity should not be a problem. That liquidity is known as market liquidity, and in the forex trading, it usually accounts for some 2 trillion per day in trading volume. Liquidity is very important, and your brokers use liquidity providers to provide them with liquidity. I will always remember when Swiss National Bank unpegged euro from Swissy, and that created a havoc in forex market. Well, I've been trading with Admiral Markets, and really I'm very, very grateful, because I didn't have a single pip of a slippage. I had taken a long trade at the floor with only 10 pip of a stop loss, and I was stopped out for 11 pip. While I know that personally other brokers were in big problems, and that move created 1,000 pip gaps on the accounts, and people who were trading successfully during the years suddenly lost their accounts. So liquidity and liquidity providers are the most important thing for a broker. And good brokers, of course, use good liquidity providers, not a single liquidity provider, but many of them. Okay? Leverage. What is leverage? We all know what leverage is, but we won't talk about specific rules for the leverage. Basically, without the leverage, you would need to have hundred thousands of price units in your account to trade. With leverage, you can trade with even $10 or $100. Okay? Leverage then is the use of the bank's or broker's money rather than strict use of your own. Forex market is a very leveraged market, and that means that you can put a deposit of $1,000 to actually trade $100,000. That is our standard 100-to-1 leverage factor. Okay? 1 pip loss in 100-to-1 leverage situation is equal to $10. So if you had 10 mini lots in the trade and you lost 50 pips, your loss would be 500 pips, not 50. We will talk about figures in just a bit. Exposure. Now, while using reduced lot size, which I always recommend, remember, reduce lot size, it will not help you very much if you open too many lots. That is why I occasionally have correlation webinars, and I will make a correlation webinar also with Forex Street to provide you with the proper information about and between correlations between different currency pairs. For example, if you go short on euro dollar and long on dollar Swissy, you are double exposed to dollar and in the same direction. So instead of making one lot of dollar trade, you would be effectively making two lots of dollar. If dollar goes down, you have a double loss. It's called double exposure. We also need to talk about emotions. We should never ever let our emotions to rule the trade. Emotions can frequently be seen as a trader's worst enemies. Okay? They often lead to misjudgment and a loss. Okay? So you should avoid those mind traps always. Greed, fear, paralyzed by analyze, all sorts of emotions. Okay? Now when we talk about specific figures concerning risk management, we should be always talking about different approaches to Forex trading. I'm talking about specifically about intraday setups. Okay? Stops which we use for intraday trading range from 25 to 50 in recent market conditions. Now, forget about 30 pip stop loss rules, which maybe were successful 10 years ago. Most of the time, intraday positions take 25 to 50 pips in today's market conditions. And very important thing is that we always educate ourselves. That is the thing, while constantly hold webinars with Admiral Markets, Forex Street, because market conditions have changed and market conditions are always changing. So we need to adapt to current market conditions. That is why systems and methods which were successful 10 years ago or 5 or 3 years ago simply do not work anymore. except for, of course, price action, which is the ultimate method for trading. But still, price action also needs some adjustments. Definitely. And especially concerning stop losses. For $10,000 account size, now this may be strange to you, but this is how I do it. Of course, 0.3 lots for each $10,000. Now let's say that you have $10,000 account. Trading 0.3 lots will give you with 50 pip of a stop loss. And now 50 pip is a good stop loss, usually, because you're taking intraday positions. With 0.3, you can take 2 trades maximum. But what traders do usually, they open one lot position and they put 50 pip stop loss, for example. And usually they don't make one trade, they make 2 or 3 trades. And look now, 50 pip stop loss with one full lot is how much? $500 per trade. That's 5% in a single trade of a risk. Okay, would you like to gamble? If you want to gamble, if you have money to spare, then go for it. It's okay. Try to gamble. Risk 5% in a single trade. Maybe you will win a couple of times, but what if you lose? And there will be time when you will have a losing streak. What then? Then I will tell you what then. You will get into a psychological, your mind trap, and you will be sucked into a spiral of doom, which we also talked about. Spiral of doom is nasty because then you can forget about all of this. If you want to recuperate your account, you will not trade like this. You need to gamble then. If you lose 50% in a single account, then forget about this, okay? This won't be useful to you because it will take ages to recover your account. But if you start to trade and adopt these things, having a good system, having a proper money management, and respecting the rules, which I have been telling you about, will make you profitable, will make you not to rush in a trade, not to rush beforehand. Okay? Simple and yet effective method to trade is by using proper risk management. So, $10,000 account, okay? It's not traded with one lot because it's gambling. Proper trading is, optimum trading is 50 pip stop loss, maximum of 2 trades. Or you can go with 0.5 lots where you can make 2 trades maximum and 1 scalping trade. Okay? Or if you make average 25 pips of a stop loss and you want to trade that 1 lot trade, that you can have 1 trade maximum because that will be your $250 of a risk and 1 scalping trade with a risk of 50. Now that is tricky and it hardly fits in. But these things do fit in. So either 0.5 lots or 0.3 lots, depending what? Depending on your stop loss. Okay? Before you even consider taking a trade, think how much you are willing to risk. Calculate your stop loss and calculate your risk, because that is what ultimately will save your account and your life as a forex trader in the long run. Making 2 to 10% per month with risk which is way above these figures is not recommended. Now, if your method is 70% successful, You don't need to have 2-to-1 reward to risk. It can be even 1-to-1. Contrary to many opinions, if your method is only 70% successful, you just can make 1-to-1 risk to reward and be successful. That means that there is always be 20% of successful trades. Now the problem is which pair to trade and when to trade. This is the problem which we are always facing. Which pair to trade, when to trade. Now it's all about your screening time, because the rules for this can be simplified, but the ultimate rule is you need to have a screening time for that. Long-term trading, which of course I'm not a big fan of, because long-term trading involves trading on weekly and monthly charts. It's not for I think it's not for building the account. It's just for investing, and there is another form of growing the account, investing. So when we are trading longer term, we are effectively investing. Okay? It's very hard to build the account with only long-term trading, because it's easier to go with scalps and intraday trades to build $1,000 account than to go with longer term trading and try to build $1,000 account. So if you want to invest, then you would probably trade longer term charts, and that involves weekly charts, monthly charts, whatever. I personally do not trade that way, because as you could see from my Forex Street and Admiral Markets webinars and Forex Street polls, which I take almost every week, I don't like to make any analysis which is 6 months ahead. I don't know what will happen 6 months in the future. Really, I don't know. Because it's very inappropriate for me. I read it occasionally from a lot of investment firms that they are predicting, I don't know, euro dollar to be on parity in 6 months. They have been predicting that euro dollar would have dropped to parity at this point. And what happened? Euro dollar is stronger than it was 3-4 months ago. Okay, so that is it's not correct to many traders, and it's not correct to investors for serious people to talk about what can happen in 6 or what will happen in 6 or 12 months time. Maybe if you want to read those kind of things, then take it always as a reserve, because anything can happen. Anything can happen. Do you have any guarantee that when you walk out from your home that a car will not hit you? Is there any guarantee? No, there is not any guarantee. There is no guarantee in your life. So try to think about it. Long-term trading is effectively trading macroeconomic events on technical analysis charts on weekly or monthly time frames. That is my definition. Now, for trading on $10,000 account, it would require really a lot of patience, because one candle is minimum 7 days of waiting for weekly, and it's 30 days for monthly. It also questions risk to reward, because long-term charts are prone to various economical disturbances and shifts. Okay? There are many times when some influential bank made a prognosis on monthly movements that change it. I don't change my opinion during intraday trading setups. Sometimes I may reverse it, but that happens once in 2 or 3 times period. So we just do not want to think, if we trade longer term, what others say. We need to concentrate on charts, and same as trading 1 minute chart. You need to trade what you see, not what others tell you to trade. Because if you trade only what others tell you to trade, eventually you will be sucked into taking only signals, not trading by your own mind and your own mindset. So, as you know, I'm not favoring that. And I always say before I make weekly recaps with Alma Markets, if your system agrees with mine, then you can take these trades which I present you. But that is okay as long as there's a good, proper stop loss. But look at longer term trading. How can you trade these kind of things? You want to put one lot, $10,000 account, and minimum stop loss is usually 350 pips. So that means that if you want to make one lot trade on 10,000 account, you would probably long-term trade would risk 35%. Well, I'm not favoring these kind of things. Now the optimum number is definitely 0.1 to 0.05 lots on $10,000 account, because that can give you one trade maximum, longer term trade, and one intraday trade. Okay? This is the maximum for longer term trading. 0.1 even cannot be traded on $10,000 account with 350, because if you want to make the risk of 3%, you won't fit in. It can be traded. The difference between 3% and 3.5 is not substantial as long as we are taking longer term trades into account. But it can be traded. So 0.1 to 0.5 lots is longer term trading. Now compare these tables and just think which kind of trader you are. Are you a long-term trader? Are you a short-term trader? Are you a scalp trader? Are you investor? And think about this. Okay, think about this, guys. Because ultimately, it will boil down to your risk management. If your account is 10,000, or let's say, guys, just for showcase purposes, you need to use 0.5 loss. That's optimum because it can give you a margin to take 6 trades. But if you make one lot on 10,000 with 10 pips stop loss, that's 3 scalping trades maximum per day. Does your system give you an edge to take 3 trades and all 3 of those trades are successful? You should think about it. It's your system, it's your methodology. Okay? Account size also. $10,000 account. It's good. It's a okay account size. But if you make intraday trading, it's usually 0.3 lots, and you can make 2 trades with 50 pip of stop loss, risking 3% per day. This will save you in the long run, believe me. Compare this table to this table. If your account balance is, let's say, $5,000, and you risk only 2% of total account per trade, and you have a losing streak of 10 trades, you will only lose 17% of the account in 10 consecutive losses. But if you take 10% of a risk, and I know that many traders really have been taking 10% of a total account risk, if they become trapped into a losing streak, they would lose 60% of the account after just 10 consecutive losses. So what kind of trading is better? Which kind is more payable, I need to say? Okay? Think about it. That is why a proper risk is always a little bit more important than having a good system or, I don't know, having a good method, whatever. For a beginner, stop loss should not exceed 1% from client's equity. Daily loss should be 2 to 3 stop losses maximum. That will give you the edge of trading 3%, not per trade, but 3% per day, not per trade, per day. Weekly loss limit is not more than 5 to 6 stop losses in a row. The less trades you make, the better is the result. Now, on the first stage, until you become a profitable trader, it's best to limit the maximum amount of orders placed per day. And always the secret of success. Losing trades should be closed fast, profit should flow. At least 1-to-1 risk to reward should be achieved. Okay? Stop loss and using a proper stop loss will slow the ruining time of your account and give you the time to compensate for it and give you the chance to turn your account into a good direction. And guys, I have a script for stop loss placement. If you need it, I can send you. Just send me an email. And do not forget, always remember, this is, guys, what I always make a focus on. Your risk is always based on how much you can afford to lose, not how much you think you will gain. So before you even consider opening an intraday position trade, okay, think about how much you're willing to lose. And if you follow these rules and thesis which we have been talking about, you will have an edge in your trading. Believe me. Now, this is what I wanted to tell you. If you have any further questions, you can, of course, ask me. If there are no questions, we can assume that this webinar is over and we can enjoy the rest of the day. And you could probably witness today analysis which I did for Forex Street exclusive analysis. If you haven't read it already, just go and read it. Euro dollar has been a great performer today. Basically, yesterday it dropped to our target and today it jumped from our POC spot. So it was very, very good week to trade. So guys, do not risk much if you want to trade properly. If you want to gamble, then again, risk as much as you can afford to lose. It's always like that. Okay, I don't see any questions, so I can assume that everything is clear. Thank you for listening to the webinar. Thank you for attending. Thank you for comments. I will be with you very, very soon. Cheers, and as always, trade safe.